Hey guys, it's May from Markets with May, and in this episode, we're going to talk about why the AMC shorts might be in trouble. Well, there's really no rest for the weary AMC shareholder, but in fairness, Mr. Aaron is clearly working up to the last hour of the year to defend the stock against short sellers. Now, there is so much misinformation out there. It's actually kind of epic, and it's really inspired me to do another video on the press releases that I covered just 2 days ago. This is a really unprecedented set of corporate actions that are really designed for a really unprecedented sort of short attack that's been happening to AMC. These releases unambiguously help the ape shareholder by a lot. And while in my last video, I mentioned that in the intermediate and long term, it would help the AMC shareholder, I now think it actually helps the AMC shareholder fairly quickly. So let me just be crystal clear. If you are short AMC right now and the board approves the remerger of APE into AMC and approves the reverse split, you need to cover, and you probably should go ahead and do that now. Now, in part 2 of this video, I'm going to dedicate it to the shorts and go through what they would need to have happen in order to be okay on their AMC short. But in this video, I want to go through the first part, the debt and equity portion of those press releases, and how that's a gigantic Christmas present to both APE and AMC shareholders. But before we get into that, a couple of shout outs. Gorilla.app, money goes where it's treated best. I work with these guys because they are of the opinion that ultimately that money is yours, and to the extent that we can educate you, that's what we're all excited to do. Second, the disclosures. I am a shareholder of APE. I do not own AMC. Past performance is not indicative of future returns. This is not investment advice. This is for educational purposes only. And quite frankly, this is one of the most interesting corporate set of activities I've ever seen. So I would have covered this no matter what. I mean, if you are a CFO, you really have to understand what precisely was done here because it's epic. Now let's go through the equity and debt portion of what happened in these press releases. Now, I want to start by giving just a little bit of background. There are 2 other videos that provide a lot more background on this. What's important to understand is that the APE share class was split from the AMC share class in a non-dilutive corporate action. And the purpose of the APE share class was always to help AMC raise capital. That was really important because at the time, the shorts were all over this stock saying that it was going to go bankrupt because it didn't have enough capital to meet its liabilities. Because that instrument, APE, was designed to absorb all of the dilution, the shorts started laying into it like crazy. Now, there has always been a provision that the APE shares could be remerged with the AMC shares at the behest of the shareholders. And at the time that I recommended it only 2 weeks ago, I will put a link to the video at the end, I felt that the shorts had been so aggressive that the valuation implied by the full conversion of the APE shares actually made AMC extremely interesting. Now that was at approximately 80 cents and the stock continued to trade lower. But there is a really important piece to this to truly understand why the pressure was so severe on the APE shares. And that has to do with an NYSE rule that requires that you be at least $1 in market value or you get delisted. Now, delisting in and of itself is not the end-all be-all killer of a stock, but it does greatly reduce the liquidity in the stock. I'm going to go through all of those dynamics far more in the second video. The key thing, though, is that the shorts were in this name, pounding it aggressively because of the potentiality of the dilution. Now, what makes AMC APE right now hard to understand is that it does involve you understanding the dynamic between the debt markets and the equity markets. Remember that the whole point of the APE shares was to raise capital and reduce the debt on the balance sheet. Now, it's typically not the case that the equity shareholder going long the stock has to be a mad genius as relates to the capitalization structure, the way in which the company is funding itself. But in this case, because AMC is a turnaround story, that's one of the most vital components of understanding whether or not AMC is the right investment for you. What you have to understand about a turnaround story is that when the CEO a turnaround CEO is brought into a company, the company is typically not in a good spot. The board has brought the CEO in, asking him to allow the company to survive and figure out a strategy to thrive. Allow the company survive involves making sure that that company is funded adequately to support any new objectives that will bring the company into the next level. And in fairness to Mr. Aaron, as much as the shorts and the haters are hating, he has done an unbelievable job of financing this company. Now, the first thing he did was during the meme period when the value of AMC shot up beyond anything that made any sense. That allowed the company to survive, and that was the right CFO move, as much as some people really got hit on the chin. And whereas that move hurt the bulls that were driving the stock price up, this move actually crushes the short sellers. Let's talk about that. Now, because this is a turnaround story and the whole thing has to do with whether or not he can properly finance this company through the really muddy waters of what's going on in the theater business, the debt capital markets are really a core component of understanding whether he's doing that or not. For my retail investors that are still learning everything about all of these capital markets, I want you to know that there is a debt market that trades publicly a lot like an equity market. And specifically, we're talking about the high yield debt market. Now, in the equity markets, when you short a stock, the price of the stock goes down because people are selling it thinking they can buy the stock back at a lower price. Now, it's very similar in the bond market, but there is another layer to this that you're going to want to understand if you're short. Now, if you short a bond, the principal value, if you were to be a buyer in the secondary market of the bond, will decline. So what exactly do I mean by that? The company still experiences the need to pay back the coupon. In this case, one of the bonds had a 10% coupon and another of the bonds had a 6 1/8% coupon. Now, at the time that the bond is due, no matter what is going on in the way that the bond is being traded, I still owe the principal amount. So let's say the principal amount due in 2027 is $100. So I still owe you $100 when that debt is due. Now, the crazy thing with AMC is the shorts didn't just attack the equity, they also attacked the debt. They pushed the value of the bond down, in the case of the 10% coupon, down to 40 cents, so down 60%, and they pushed the 6 1/8% bond down to 30 cents or down 70%. That meant that for every dollar that was owed, whoever the lender was happy to just take 30 cents or 40 cents to close out the debt. They thought that they would get nothing, so they were more than happy to take 30 cents or 40 cents. And then what they did was they told the world, hey, the bonds are trading busted, which is a technical term meaning that the bonds are trading like the company is going bankrupt. So therefore, AMC, APE and AMC are a short. Now, a strange nuance of the equity versus debt markets is typically the equity market shareholders believe that the debt guys are really smart about how to price the debt. That as it relates to bankruptcy, the debt guys tend to know that first. And so this shorting of these two bonds really gave anyone on the AMC or APE side pause. Now, it has historically been the case that when the bonds trade busted, which is trading such that it looks like the debt holder believes they're not getting their principal back, that it's a very bad sign for the equity holder. But in a world where people are not necessarily double checking all these things, you end up with the situation we currently have now, which is going to be a little painful for the shorts. Now, it turns out it only makes sense to short the stocks and the bonds if you're sure this man can't get funding. But what if he can? Now, this is where it can get confusing for retail investors, so I'm going to try to take all the jargon out. If I go to the bank and borrow $100, and during that period of time that I'm borrowing it, my credit score might fluctuate, which is kind of what it means to price that bond in the market. My credit score is fluctuating like crazy. It doesn't matter because at the end of the day, I still owe $100 plus interest payment. If I can pay it, we should be all good. Now, if the bank were to sell my loan to my mother, for example, and my mother says, you know what? Mr. Banker, what are you selling me the loan for? And they say, I'll sell you the loan for $30. Then she could buy the loan. And then because she's my mom, she could just be like, hey, you know what? Just pay me back $30 and the loan is done. I want you to understand how epic this is. I received $100 from the bank. And let's say this loan is 2 years old and I'm just paying $10 each year on it, right? So I received $100. I'm paying the bank $10. So thus far, I've paid $20 on this loan. And my mom is saying, just give me $30 and we'll call it even. That means I get to keep the $70 that the bank gave me minus the 2 interest payments, $20, so $50. So that 50% remaining, that's just cash for me. How epic is that? And so that's what Mr. Aaron did. He used $30 million of net proceeds to buy back busted up bonds on AMC. Now, he does discuss this pretty clearly in the December 19th release. And then there's more discussion of debt retirement in the December 22nd release. Now, because there's so much in these 2 releases and you do have some corporate costs that are associated with this, it is going to be a little bit hard to do the math on precisely how bad it is for the shorts that this has happened. Needless to say, though, it's really bad for the shorts. And that is because he did not fund these bond buybacks with cash. Now, I want to talk about how brilliant that is. If he had funded this in cash, the short sellers would just come back and be like, he used all his cash to buy back these bonds. He's totally insolvent. Instead, he went to the equity markets to capitalize this. So that's what's making the press release difficult to read. But essentially, he asked for money from the equity capital markets to, number one, buy back this silly debt. And number two, just have enough extra money in the war chest so that this doesn't happen again. Now, this is something that is highlighted very clearly in the November 19th press release, and it's a little unclear if November 22nd adds even more to the war chest. But if you use the numbers in the release, you'll see very clearly that, first of all, he has more than enough to cover his current liabilities. And also, as a function of paying off some of his debt, he has lower interest expense. Now, all of that mumbo jumbo is really going to mean one thing, and that's this. The short sellers are really going to have to think twice about using the bond markets as a way to get the equity sellers to short the stock. What Mr. Aaron has demonstrated is that if you are dumb enough to give him back his debt at 30 or 40 cents on the dollar, he will find a way to buy it back just so that he can keep the spread of that 60 million or 70 million that you're happy to give him. Now, I got to tell you, just that right there is some straight up CFO boss moves. I mean, it is really next level. However, you're really going to want to watch part 2 because that's where the most misinformation is. The remerger of AMC shares and then the 10-for-1 stock split is going to put the shorts in kind of a nasty spot. Well, that's all I have for this episode. You know the drill. If this added value, it'd be amazing if you would like, share, comment, or subscribe. And especially if you are a debt specialist, I want to hear from you below. That would be so awesome if you have additional color. Here's the video of the remerger and the 10-for-1 stock split. And down below are some other videos that you might just find very interesting. Hopefully I'll see you in the next video.